Welcome to Let's Talk Global Business, the show in which we look at the economic and business trends connecting the world. I'm Sarah Murray, Managing Director International at the Conference Board, the member-led global think tank that delivers trusted insights for what's ahead. For most of the past century, growth has been the central goal of economic policy, the defining measure of progress and success. But that era is fading. In many parts of the world, decades of rapid expansion have given way to slower, more uncertain growth, even as other regions continue to surge ahead. In this episode, we'll look at why growth feels harder to find and where it might be still emerging. Joining me today is Tony Verb, Executive Director of Carbonless Asia, and Alejandro Fiorito, economist for our European Economy Strategy and Finance Centre at the Conference Board. Welcome both. So to kick things off, I'm going to ask you both a simple question. Is this the end of growth? Alejandro, do you want to go first?
Sure. Thanks, Sarah. I think this is a very important question, which does not have a simple answer. It is rather clear that growth, as we've known it in the last 20, 30, even 40 years, is changing and decreasing. And so far, the world had gotten used to a global growth above 3% on the back of large developing countries like China or India growing very fast at rates of 6, 8%, and advanced economies growing fairly consistently around 2%. That, if you look at many different forecasts, is coming to an end. And it's quite a large change, because if you look at the last 40 years since 1985, there have only been 10 years where growth has been below 3%. And that's where we see forecasts for the next 5 years, all consistently below 3.2%. So we're expecting growth to be below its long-term average and in a range that is on the low end of the historical distribution. And this has many explanations. Most are well known: China facing an aging population and domestic headwinds, trade tensions everywhere, and advanced economies, particularly in Europe, which have even larger issues with aging populations, also having had to confront multiple shocks in recent years that have left lasting scars. So our baseline scenario is that global growth will be lower over the medium and long term. And this is an important conversation. So we should be talking more about why that is the case and what can be done about it.
Tony?
I'm more in the business of investment and trying to predict certain industrial trends. And from a very basic capitalistic perspective and following a capitalistic logic, I just simply don't believe it's the end of growth, because our systems, our financial systems are addicted and are designed for growth. So growth will be chased by companies, by economies, but certainly automatic growth is probably coming to an end. I think altogether forecasting is right now more difficult than ever. There are a couple of trends that are culminating at the same time. Alejandro mentioned the aging population in China, which is not only happening in China, but there's a huge demographic shift globally, which is happening in different ways and different patterns in different parts of the world. So there's a demographic shift that's happening. And obviously, there's a huge technology shift that's happening. And we will have to say this word, AI, that's changing all industries, changing the nature of jobs, employment, changing the productivity gap, or the nature of the productivity gap between different companies and economies. And it's impossible to predict how this will unfold. So I think part of the special nature of this era is that it's much harder to forecast than any time over the past decades. There will be a new pattern of growth. And as a consequence, it's very difficult both for policymakers and business leaders to plan and make decisions.
Thank you. Thank you. So, I mean, as we've heard, so it's around the world. It's not growth is slowing, not necessarily stopping, but different views. Are we seeing an end of a cycle or the start of a different kind of model of growth altogether? You talked, about AI. You talked about, there's a lot of kind of forces at work here. What do you think might be emerging, Alejandro?
Yeah, if you think, just to go one by one through the basic drivers of growth, if you think about labor, there's questions around how much migration are advanced economies going to be able and willing to accept to compensate for an aging population. Around capital, it's unclear still what the return is going to be of new investments in digital technologies and of public spending in defense that we're seeing increasing substantially. And of course, as Tony already mentioned, AI is sort of the big elephant in the room, and it's still quite early to even start thinking about predicting with some confidence what the impact of AI will be, particularly on productivity. To give you an idea, some recent numbers released by our colleagues in the conference board from New York show that 81% of CEOs in the US expect AI to fundamentally change a majority of jobs within their organization. So we know the change is coming. We know it's going to be substantial, but we don't know how that's going to translate into productivity and growth. So in that sense, we're entering a time of structural change. We also, as I just mentioned, the private sector investing in new technologies, and we can sort of think of the public sector in a way shifting some of its investing towards old industries, and I'm talking about defense, particularly for Europe, but also globally. What is clear is that risks to growth are tilted to the downside, but that there is also still some potential for upside, and that's where the uncertainty comes.
Yeah, thank you. Tony?
I would probably add to the very sharp and smart points that Alejandro made, two aspects. One related to capital. I believe in this new cycle, in this new era, not only the returns are uncertain, but also the cost of capital is uncertain. And for the past many decades, but certainly the last decade, our economies and structures and companies have gotten used to cheap capital. And it is very much the view of the majority that it will not be coming back for a while. So the cost of capital will be higher than what the most recent crop of leaders has been used to. So what is the cost of capital? What is the reasonably expected return on these new digital infrastructure and digital investments that have been made and will have to be made by companies and economies? So that's a huge uncertainty. And that can be felt across the capital markets. That can be felt in venture capital, where I've spent over a decade. This is not a good time for venture capital. And that's a good reflection that there's huge uncertainty. And that is also a reflection on the type of an amount of risk that investors are ready to and are considering to make these days. And I think the other component that we also need to be mindful of is the nature of globalization. Obviously, we are now getting into localization and regionalization. How this process is going to unfold is still very much uncertain. Countries, economies, companies are making bets and trying to de-risk this process, but no one really knows how globalization will look like and global value chains, supply chains will look like in 10 years. So I think these two components are adding to the complexity to the new cycle that we are talking about and discussing.
That's really important framing that you've just both made. There seems to be many questions, lots of uncertainty. People aren't sure about the ROI of the different kind of structural changes and the investments that they're making. So there's a huge amount of unknowns, more so than ever, that exist right now, which makes it incredibly difficult to predict and to plan and you know, to kind of know whether those bets are going to pay off. That said, the US economy has shown surprising resilience. It's got, you know, strong job growth and investment in tech and infrastructure. What do you think explains the difference, and is it sustainable?
Yeah, I think the explanations are somewhat known, and the bottom line is the US has a very dynamic domestic economy that is able to absorb substantial investment and achieve, and this is mainly through the tech sector, but also it's a fairly diversified economy, significant productivity gains. And this has been enabled by both structural and cyclical factors. On the structural, we often talk about the exorbitant privilege that the US has by having the US dollar. And what we mean by that is that the US currency is central to the global financial system. And effectively, this status means that when there's global turbulence, capital flows in and not out of the US. And that allows for cheap financing for the public and the private sector. But there are also cyclical factors that are currently or have been playing a role. A significant one is migration in recent years, which has strengthened the labor market, sort of pushed back against those demographic headwinds that most advanced economies have. In terms of whether this is sustainable, we are, of course, seeing US policies that are reshaping some of these drivers, including a very harsh stance on migration and a more protectionist approach to global trade through tariffs. This, I think, is, of course, inevitably going to erode some of the global or change the global status of the US and potentially erode or change some of its strengths. We are seeing some of that in the growth numbers for the US already. But on the other hand, the US is betting quite big on AI, on digital technologies, on digital assets, mostly through a deregulation push. And while we can have some questions around policy design or objectives, as a general rule, I wouldn't bet against the US and its growth and the strength of its economy.
Thank you, Tony.
I can only echo Alejandro's points. Probably would like to underline there the capital market of the US. Obviously, there has been a significant capital inflow already recorded, and that is a historical pattern that is being reinforced right now. But in general, when there's a big shift like what we are experiencing right now, and that shift is technology and innovation driven, and that requires risk-taking and capital that's ready to take risks. The US is second to none when it comes to the depth and breadth of its capital markets, the kind of bets that the different stakeholders and players in those capital markets are ready to take. And as Alejandro mentioned, the depth of the economy that can absorb such capital deployment and the diversity of the economy is significant and probably hard to compare to any other market around the world. So that's one aspect. The other aspect is probably the reindustrialization aspect that has been not only happening since the new administration came into power, but through the CHIPS Act and IRA, it has been in place, or the previous administration, which generated, catalyzed more than 600 billion US dollars in private investments, seriously significant. If I believe this has happened only over the past couple of years, probably 2 years. And that reindustrialization and attracting foreign capital has been doubled down on by the current administration. So we are probably seeing some of the effects already or still from the previous administration's reindustrialization policy, and will be or are already probably seeing the effects of this administration's reindustrialization policy.
I think we can still concur that the US does stand out, but as you both point out, that resilience may face some limits and be difficult to sustain, especially if the trade tensions deepen and the fiscal space narrows. But so far, it's so good. If we move to Europe now, savings remain high, but the investment lags behind. So why is it proving so difficult to turn capital into new industries and innovation? Alejandro?
So in Europe, there are issues related to scale and regulation, and both are intertwined. And to echo what Tony was saying, capital markets need to be deep and need to be ample, and that's not the case in Europe yet, because our capital markets are fragmented with significant national differences in terms of insolvency, tax, supervision, laws. So that is the main constraint right now. And proposals, for instance, around the 28th regime are quite ambitious and aiming to solve this issue. But there is, of course, not a quick fix. And I think to some extent, cultural and entrenched realities are hard to change. We see that the system, financial system in Europe is quite focused around banks. We see that households keep a large share of their assets in deposits and cash, like around a third on average of household assets are cash or deposits in the EU. And countries with more successful capital markets, and we don't even need to go as far as the US, but we can look at Sweden, show that deposits and cash for households in Sweden represent only around 15%, so half of the EU average. There is also the issue that firms leave Europe often. Once they start scaling up, mainly, and we can think the very discussed case is tech to the US. And this is in part because the capital is not there, but also because the cost, and Tony made this point before, around the cost is very important to measure. And we can think about cost of failure and even cost of success for companies. And what I mean by this is the cost of failure in terms of insolvency and bankruptcy laws is relatively higher in Europe, but also the cost of success.
Thank you. Tony?
Well, once again, I can only agree with Alejandro's points, excellent points, and probably would highlight and re-emphasize two components. One is the cultural component, and the second is the fragmentation component. Fragmentation, I believe, is a serious issue in Europe, despite or the European Union, and despite it being the most successful trade union in history, the fact still exists that there are multiple languages, multiple regulations, multiple different cultures, and so for companies and businesses to scale in this environment is a very, very different task, and a way more complex task and way more costly task than scaling in the US. And that's one of the reasons why indeed those successful, promising, scaling new technology companies move to the US, or move their attention and their priorities to scale across the United States and perhaps list IPO in the United States, get acquired in the United States. So I think that's a serious challenge within the European Union. I do also think that there's a culture of conservatism when it comes to business. The risk taking is just simply different culturally. The appetite for risk taking, the track record, and the output of risk taking, as Alejandro said, the cost of success is higher, and the revenue or the price of success is typically lower than in the United States. So there's less incentive, as a consequence, less players or less dynamism around business in general. And I would like to just bring an anecdote from a couple of years ago when Siemens and Alstom were about to merge their railway operations, and it was celebrated as a step or an example of creating a new European industrial giant to compete in the global markets. And ultimately, it was not given the green light. So indeed, regulation within the European Union is still not favoring creating the kind of continental champions, if you will, that could successfully compete on global markets. And I think this is a significant global competitive disadvantage for European Union companies. So fragmentation, regulation, culture, and perhaps for these years that we are going through, the vicinity of the Russia-Ukraine conflict and war and the effects of that, the cost of energy, are all impacting business, industry, and risk-taking.
Let's move to Asia, because obviously the story is very different there. We've got China's momentum cooling while India and ASEAN are accelerating. What do you think explains those contrasting paths, Alejandro?
Yeah, so in Asia, we see those diverging patterns, and I think China's growth is the big question, right? And what we're seeing is some domestic headwinds that contrast with China maintaining a very dynamic and aggressive, if I may say, external sector. We've seen how the trade tensions with the US and the tariffs have resulted in China's exports to the US falling quite considerably, but if you look at their trade balance and their trade surplus has been maintained. Their total exports and total imports have not fallen. And that's because they've started to trade more with other regions, including within Asia, Africa, of course, and Europe as well. So there is that tension between the external and domestic sector, and that is a tension that's going to start to resolve itself to some degree, I think, in coming months. On the more positive side for Asia, we see India still being quite strong, and showing some more perhaps resilience to this uncertainty, this global uncertainty. And we're also seeing in Southeast Asia countries like Vietnam or the Philippines that are growing consistently around 6%, and are expected to grow around those numbers. And they might have even benefited a little bit from trade diversion and from diversification.
Tony?
I must say that the confidence level in China is relatively low when it comes to business in general, but there's still a lot of business being done, and there's still a lot of investments being made, and there are a lot of success stories that we can still talk about. Obviously, partly what pulls China and China's growth down is the troubles in the real estate and property sector. That's a huge chunk of the GDP. That has been somewhat self-inflicted, and probably the headwind is greater, or the crash and the impact is greater than was expected. But that is also expected by the market to be dealt with on the short mid-run. That will give China a good potential boost over the coming years. Secondly, when it comes to China, everyone expected, I think all of us expected, and the forecasts were showing that the 5 to 10% growth rate is simply not going to be sustainable and not going to persist forever. And probably we are just experiencing and seeing that super high growth to an organic end. And around 5% growth is still very, very healthy in an economy that's aging and in an economy that's investing heavily in future technologies. When it comes to Southeast Asia, it's a bit of the story of the European Union. It is also fragmented. Different countries have different levels of success and growth. As Alejandro mentioned, Vietnam and the Philippines are enjoying very good growth right now. In certain parts of the ASEAN, there's more conflict and more troubles. It's enough to think about the Myanmar civil war. In Japan and South Korea, we see high-tech stabilization. In India, we see indeed that very high growth that I believe will sustain and will be sustained for the foreseeable future. But obviously, for all these economies, the baseline is very, very different, or has been very, very different.
I mean, it's almost like we got so used to the huge levels of growth each year, but almost that going on for so long was quite extraordinary. And now that we're back at, you know, the 5%, like you say, it's still respectable. I mean, even with the trade tensions, the property weakness, you know, that they'll find ways, right? Pivot to other markets. And then India and parts of Southeast Asia finding like new momentum through either domestic demand or, you know, capturing supply chains as global production becomes more distributed. So you're right, there is not one size fits all for that region, but lots of dynamic changes, I think, that are going on there. So definitely one to watch. Next, let us look at how business and policy can respond and what a new growth playbook could look like. So if we think about slower and more uneven growth being the new normal, what kind of leadership does that demand from both policymakers and investors? Alejandro?
So I think two defining factors or features here are going to be, from a leadership perspective, honesty and pragmatism. And I think honesty is needed in recognizing that there are no easy answers, that there's not an easy fix for the problems we face today. We need to recognize trade-offs and the cost of choices. And we're actually working a little bit on industrial policy. So from a policymaker perspective, it's interesting to see how the literature on industrial policy has grown, and how it emphasizes both diagnosis. So again, sort of that understanding of the problems and understanding of the trade-offs, and then how the literature is pretty clear about what constitutes good design, good responses. And that's, I think, where the pragmatism comes in terms of leadership, because that is needed to deal with trade-offs. And that means being flexible, being adaptable, being open-minded to partnerships, to new technologies, be able to deal with new and changing scenarios, new shocks. So I think there are lessons on policy design, on industrial policy design for leadership, and they are around careful diagnosis and quite pragmatic and applicable design.
I would like to double down on Alejandro's point on adaptability, both from businesses and governments, policymakers. Building adaptive systems, cultures, processes is going to be critical, partly because of the uncertainty that we are facing, but also because of the speed of change that we are experiencing, which is probably greater than ever. And it's quite interesting that we're talking about a slower world that is slowing down in terms of growth. At the same time, the speed of change is accelerating continuously. The other attribute that leaders probably have to strengthen is daring. They need to be braver because there's more uncertainty. It's much harder to forecast. They will have to be brave, stepping into the unknown, and be adaptively brave, if you know what I mean. They will need to know when they made the wrong bets and be ready to take more probably smaller bets and a couple of very big ones, and be honest, as Alejandro also said, to face the results and tweak the strategy.
Yeah, so interesting. Beyond Asia and Europe, could we just take a few moments to talk about Africa? It's got a young population, it's expanding cities. Could it become the next major growth region, and what would determine whether that happens?
Yes, to some extent, there is an inevitability in Africa being more significant, and that just comes from the population projection. So if you look at current population in Africa, it's around 1.5 billion. So the continent is as large as China. And in 25 years, by 2050, it's expected that it would be around 2.5 billion, which will represent around a quarter of global population. Still, GDP in nominal terms will be below 5%. It's expected to be below 5% of total global GDP. So the big question is whether labor is there. There is a young population that is going to grow fast, but the big question is going to whether capital is going to follow and flow significantly towards Africa. There are reasons to be optimistic. The growth of the cities, large urbanization, the digital advancements that we see, the expansion of G4 networks. And of course, Africa is a resource-rich continent, which in this era of critical raw materials makes it particularly appealing for investing. And finally, I would also say on the positive side that it has the potential to be an engine of clean energy production. But that is not straightforward, and we know that still much needs to be done. Africa has had historically quite low FDI, and many of its countries face large debt issues and constrained public finances, which will limit how much it can actually invest on crucial things like infrastructure. In addition, I think that we expect some potential from, for instance, as I said, the critical raw materials, but with that, there will also come the geopolitical and geoeconomic tensions that we see now in Europe, in the US, everywhere in the world. We are already starting to see those in Africa, and that would be a challenge that I think relates to the main challenge that Africa has, which is being able to reduce uncertainty coming from its own continent, from its own governments, and providing solid foundations around stable macroeconomics, infrastructure, as I mentioned, to truly benefit from that potential. So still, there is a lot of work to be done around human capital, political stability, rule of law, such that we can then see capital flow in, and we can see countries in Africa really capitalize on their potential.
Thank you. Anything you want to add, Tony?
Probably on the last point that Alejandro made, rule of law and stability, and those are two key components that will drive Africa's growth. And for Africa's growth, we need capital and FDI. And FDI and capital will only come if there's rule of law and stability. So it's an extremely high risk type environment currently to invest in. That kind of needs to change for the real potential of the continent to be unlocked. However, as Alejandro mentioned, the sheer population growth and urbanization is expected to drive pretty sustainable and reliable growth for the coming decades. It's enough to say that according to forecasts, Lagos will be the largest city in the world by the end of this century, with a projected population of almost 100 million people. So that's just a very good and visual example of what change is expected to happen on the continent, and in the context of its role in the world and around the world. The quality of that growth and the scale of the transformation will depend, I believe, very much on the rule of law, trust, and the development of the human capital component. If those are somehow solved, at least in a majority of the countries on the continent, the growth can be tremendous. And those countries that can get it right can get very much ahead of the rest.
So we've talked a lot about the environment and all of these kind of forces at play. If we just now pivot to think about how business can respond, what do you think all of this means? One, for how kind of companies plan and invest, and then the other for like how executives thrive in this very uncertain environment. What advice would you give, Alejandro?
So we've talked about how uncertainty, I think is the defining feature of this conversation, but also the times we live in, right? So how companies deal with uncertainty is going to be, I think, the defining feature of their success. And to deal with uncertainty, you need what I've mentioned before, the diagnosis, and to go a little deeper on that, what we mean is companies need to determine what is good enough for them, what performance, and they need to be very clear around that. But given increasing uncertainty, it's not only about what is the goal you want to achieve, but also under what set of circumstances you want to ensure that that goal is achieved.
Tony?
I will just underline adaptability. Indeed, it's the name of the game.
Yeah.
I also would like to applaud Alejandro for highlighting the importance to set goals. I think we live in an era where choosing to go global is much less straightforward than it probably was 10, 20 years ago, at least in general. Obviously, when it comes to digital products, services, it is in many ways easier. But I believe setting the expectations and the goals of how local, regional, or global a company wants to play and compete changes everything to start with. And even if one decides to scale or seriously innovate, I believe a form of adaptability, or to strengthen the adaptability of a company, is what I would call in the form of modularity, to create within the supply chains, within the value chains, within the company, a sense of and a structure of modularity, i.e., if one fails, the company and the entire company doesn't go down with that module, business unit, product, etc.
Thank you. Excellent takeaways. I think you're right. It's clear that leadership now means embracing uncertainty, and agility is absolutely necessary, and just being able to build organizations that can evolve with all the disruption that's at play, and just treat uncertainty not as a risk, but now it's a constant part of the strategy. And I really take away as well that it's a good reminder that growth is changing shape. It's not necessarily disappearing. There are opportunities there. It's just in different places, and at a different pace. But business leaders really need to just be adaptable, and really kind of much more flexible in this very volatile environment. Well, that brings us to the end of this episode of Let's Talk Global Business. We'll be back next time with a focus on a new topic. Thank you, Tony and Alejandro, for sharing your insights with us. You can find more content on the economy and listen to the entire catalogue of this series by visiting our website at conference-board.org. Until next time on Let's Talk Global Business.